Hey friends, Lucian here with the Bullish Bears team. This video is going to be about debit spreads. So a debit spread is the simultaneous buying and selling of calls or puts that have different strike prices in the same expiration date. It gets the name debit because the money is taken from your account right from the get-go. So in essence, you're paying to make the trade. The money is debited from your account. So when you go to use your debit card in the real world, money comes out of your account. Now, this differs from credit spreads where the money is credited to your account right from the start. Here's an example of a photo here, a screenshot from my Thinkorswim platform, and you'll see here, taking a look at Facebook, you'll see it's the combination. If you look at the bottom left corner, you're buying the primary, right? So the first strike that you buy is your buying strike, and then your second strike is the one that you sell. So it's a combination of buying and selling. And if you look at those differences in price, that $9.25 minus the 805, that's where you get a $1.20 debit. So it costs $120 to enter into the trade. When I took this screenshot, you'll notice it's a little bit different than the order dialog because when they take the screenshot, obviously it's live market hours, so the price, depending when you take the screenshot, it's not going to be completely exact, but it's pretty much almost on the money. So again, when you go to place the order, it's that debit amount. That's what it costs you to enter into the trade. Now, the world of options can be tricky sometimes because sometimes, the same strategy will have several different names. So with debit spreads, there are two most common names, but there's also even third and fourth that, there's 3 or 4 different names for the same exact strategy. But I'm going to talk to you about basically the 2 most popular, and each of those have, 2 most popular names. So with debit spreads, the most popular bullish strategies are called call debit spreads and bull calls. So that's the same thing. So if you're bullish on a stock and you hear the term call debit or bull call, same exact strategy. You might also hear the term long call or long vertical as well. So sorry to be confusing, but that's the world of options. Just kind of be aware that, many times, again, doing the same thing might be called 3 or 4 different names for whatever reason. It's a bit annoying, but that's the real world of options. So as far as the bearish side of the house, the 2 most popular names are put debit or bear put. You might also hear short vertical as well. So again, take a screenshot of this, kind of keep this handy. So when you're going along the way, if you hear the terms, call debit, bull call, put debit, bear put, you'll know what they mean. And in essence, they're called the same thing for the same strategy. So what are some of the positives and negatives of debit spreads? Well, one of the biggest positives of debit spreads is that it lowers your break-even point compared to trading naked options. So when you're trading a naked option, you got to be very directionally biased. Whereas, again, with a debit spread, you still need to be directionally biased. But when you're doing that combination of buying and selling an option, it lowers your break even. So if you get the direction right, it moves a little bit quicker in your favor. Another positive is that it's less capital required to enter into the trade. So the combination of buying and selling the option, it costs you less to enter into the trade. A couple of the negatives are it limits your gains. So if you're trading naked options, you can get unlimited, gain potential. But again, also the odds are against you more because time is against you when you're buying naked options. So you have to be right on the money when you're buying a naked option that you get that direction right. And that's where with debit spreads, it is still a negative because it's not, you don't need to be as directionally biased as trading a naked option, but you still have to be more directionally biased than you would, let's say, with a credit spread. Now, there are several different ways that you can structure a debit spread. We'll look at one of the most common, which is where you straddle price. And how that's done is you basically look at current price and then you look at the at the money. So you go to the at the money strike, which is basically the price or the strike that's closest to the current strike price, which would be right here, this 275. And then you would straddle price. Again, there's several different ways that you can do debit spreads, but for the sake of this video, I'll just show you how to straddle price. So this is where you would buy vertical right here, and you'll see I bought the 275 and then I would sell the 277.50. So you'll see price is basically in between over here. So you'll see it's the combination of buying an options contract and then selling an options contract. And this is the debit amount, right? $1.20, that's what I would pay, or $120 because it's 100 shares for each options contract. So when I confirm and send, you'll see right here the order dialog box. You'll see the max profit right here. So the profit is capped right here. So it's $130 max profit. Max loss would be $120, which is basically what I paid on the trade. So if you compare this to just trading a naked option, you'll see right here, if I X out of this and just delete this order, if I just bought this naked option right here and bought it by itself, it would cost me $950. So my max loss is $950. My max profit is infinite. So yes, you can make, let's say, infinite profits, but also the losses are a lot higher. And also take a look at the break even. So on this naked option right here, my break even is 284.50. So price needs to move to 284.50 by this expiration date for me to break even. So if you see when I go back, so that's 284.50. If I go over and do that debit spread again by vertical straddled price, my break even would be 276.25. So this is where it shows that price doesn't need to move as high in my direction as I would with a naked options contract. So verticals, again, they limit your profit, but they also lower your break even. Again, you still have to have price move more in your direction, but a lot less than you would with trading a naked option. Now, again, there are several different ways that you can structure debit spreads. You can play around with strike prices as well. So you'll see this is the one with straddling price. You'll see max profit 127, max loss 123. I could always increase right over here. My strikes go up to 280, let's say, and you'll see my debit just went from 120 up to 233. So you'll see what that basically means is I just increased my profit, also my loss as well. But, again, this is where before you just go buying and changing around the number of options contracts, you can play around with the strikes to get more of the risk reward that you'd like. So again, kind of just play around, kind of get the, your comfort level of your risk reward that fits you best. So overall, debit spreads are a great strategy for, if you're pretty decent, directionally biased. Again, don't just buy, especially with options, don't just blindly buy or sell any type of options contracts or any type of strategy without understanding your proper, support and resistance levels, understand technical analysis. That's the stuff that we teach you in our community. We also do real-time options alerts as well. So we call out real-time, debit spreads as well as credit spreads within our community. So if you want to receive our real-time alerts, make sure you subscribe and become a member. So hopefully this video helped you on debit spreads, and we will see you in our community. Enjoy.